Senhoras e senhores, muito bom dia. Sejam bem-vindos à Conferência Anual do Banco Central do Brasil 2025, que tem por objetivo estimular o debate e a pesquisa nas áreas de macroeconomia, sustentabilidade, estabilidade financeira, economia bancária, inovação financeira, regulação macroprudencial, economia internacional e finanças. Nestes 3 dias, contaremos com apresentações feitas por acadêmicos, especialistas do setor privado e representantes de bancos centrais e de instituições multilaterais. A cada manhã, teremos uma palestra magna, que será transmitida para o canal do Banco Central do Brasil no YouTube e sessões paralelas de apresentações
at the YouTube channel of the Central Bank and will be recorded and available on the bank's website. You may find the complete program of the event on our website or through the QR code available on your identifications. We have a partnership with FGC for the organization of this annual conference. We also have the support of the following institutions: the Brazilian Association of Payment, ABPAG, the Brazilian Association of the Financial Market Organs and of Capitals, ANIBAMA, the Brazilian Federation of Banks, FEBRAN, ZETA, the Association of Companies dealing with technology in the financial sector, the Brazilian Association of Banks, and the National Association of Credit Institutions, Finance and Investment, ACRE. For the opening speech, we would like to invite Diogo, Guillen, Governor of Economic Policy of the Central Bank of Brazil.
Ladies and gentlemen, good morning. It is with great joy that we begin this annual conference, which is consolidated as an important forum for exchange of ideas and studies and debates of relevance in the bank's work. We support institutional values, in particular transparency, keeping with the tradition of dialoguing with the academy on public policies based on best practices, economical theories that are most advanced, and others. In the name of the Central Bank of Brazil, I'd like to thank everyone, especially those who will be debating, speaking, and moderating, who have accepted our invitation. It is certainly indispensable for the success of our event. We have specialists from many central banks and other multilateral entities and research entities in the world. We will have 40 works that were chosen out of 330 articles submitted through a public call, dealing with macroeconomy, sustainability, financial stability, bank economy, intermediation, and financial innovation, macroprudential regulation, international economy, and finance. We will have academic presentation, and it is an honor to have everyone who will be speaking. We will have Jean Tirole, who is a Nobel Prize winner. We have Michael McMahon and Frank Smets from the BIS, all of whom have great recognition in their areas of expertise. We hope that everyone will be able to take part of the sessions because the quality of the works is very exciting to stimulate debate and to introduce important debates. The central bank has an important role when it comes to monetary policies, stability, and bank efficiency. We have results of analytical tools of high quality that are used to take decisions in terms of policies. We have themes that take into account the aims, the strategic aims of the central bank, and the recent challenges that have been brought by technology and innovation. A new research agenda, which will now go up to 2029 for strategic planning here at the bank, is under review. And among other issues, we will have a new emphasis on the understanding of the channels of monetary policy, as well as broadening the access of the public to credit at a lower cost, which is part of what Mike McMahon will speak about. Also, specific regulation that establishes the execution, the approval, and publication. The main results of the activities of research of the Central Bank are on our website, which adds different vehicles specifically for 600 works all up to now. Many of these works become external publications, are also spoken about in congresses and debates outside of the bank, other central banks, and multilateral organizations. Another important vehicle for the spreading of our works is the World, the BC, which happens every 2 or 3 weeks with an analysis. Research also spread in special studies and bots. We have partnerships with other institutions and researchers to develop research jointly. And for the second semester of this year, we will launch tests for a microdata lab and our transparency room. After going through the trial phase, we are working on the generation of data and simulations so that it's possible to implement them in practice, the use of the room with other partners. We will choose some researchers to begin the tests shortly. In this annual conference, we have more reasons to celebrate and think about our path. We are 60 years old, providing services to society since its inception in 1965. The central bank has been integral for the economic stability of the country and in the promotion of financial viability. Along these 6 decades, we have faced many transformations and challenges, among which we have the 30th anniversary and the implementation of the goals to control inflation, and this has meant a huge step forward for our country, for more credibility, monetary policies, increasing transparency, the creation of payment systems a payment system in Brazil for more security in financial transactions. PIX was launched, which has revolutionized payment in Brazil. Many other steps to contribute to resilience, the 179 law for governance and technical capacity of the entity, and other issues such as sustainability and green finance, which have placed the central bank as an integral part for a building of a more resilient and inclusive future. Generation of also public employees and the search for excellence. The central bank produced an almanac, a calendar with the highlights throughout its history. We have photos, graphs, along a timeline of events that can be accessed on our website. 60 years of the central bank is important for us to reaffirm our commitment with innovation, transparency, and also acknowledging the challenges of the present, for which we need to be more open and transparent, and these are values that are underpinned by this conference. The task we know that everything we've done is wonderful, but we still have a lot to do. We have to promote actions, maintaining excellence that the Brazilian society deserves and should get. The evolution agenda of PIX, such as automated PIX or or others. Open finance is another example, consolidated as one of the important references and is under improvement at the moment, as is the implementation of other services. It's many deliverables and an agenda that's full of challenges that relate with one another and strengthen the aim of stabilizing price in a period that involves inflation. I wish everyone a wonderful event with productive debates. Thank you very much. Thank you very much for your words, Diogo. We will now move on to our main presentation. I'd like to invite Renato Gomes, Deputy Governor of the Financial System and Resolution at the Central Bank of Brazil. And Professor Jean Tirole, professor at the Toulouse School of Economics and Nobel Prize in Economy. We now would like to pass the floor to Deputy Governor Renato to moderate this session.
So good morning, and thank you all for being here. So I don't think there is much need to present Professor Jean Tirole, so I'll be brief. So Professor Tirole has been living many lives as a researcher. One life he lives fruitfully is that of an industrial organization economist. So his early contributions already granted him a Nobel Prize. He has also been living parallel lives as a theorist, as an economist of organizations, as a corporate finance expert, and even as a behavioral economist. So today, we'll see yet another facet of his encyclopedic interests. I'm talking about his contributions to financial economics, which are so close to the hearts and minds of the central bank community. So Professor Tirole, fresh from his PhD, produced fundamental contributions on the theory of rational bubbles. Later, together with Ben Holmstrom, Professor Tirole developed the framework based on agency theory for the study of financial intermediation. Their seminal contributions produced the rationale for the public provision of liquidity and for the design of capital requirements, becoming a workhorse for the study of prudential regulation. More recently, together with Emmanuel Farhi, Professor Tirole leveraged on agency theory to revisit his early interest in bubbles. Notably, they also investigated the incentive effects produced by the relationship between banks and the government. Today, Professor Tirole will update us on the recent developments of his incredibly fecund life in banking and finance. So thank you so much for being with us today. The floor is yours.
Good morning. It's a great pleasure and an honor to actually be giving this keynote lecture at the conference of the Central Bank of Brazil. And I want to thank the Central Bank and all the partners of the central banks who bring this wonderful audience here for this conference. So thanks so much for the invitation. It's also, of course, a great pleasure to be introduced by someone, Professor Gomes, who is a co-author, a colleague, and above all a friend. And that's very nice to be here and be giving this lecture. It's also a little bit intimidating because you are experts in the field. And as Renato explained, I'm doing various things and I try to be competent in the various things, but I also have limited knowledge. But what I can bring to you possibly is a different angle to think about those things in a slightly different way, maybe. So, Sorry, I didn't know where the control was. Okay, so this is going to be about liquid assets, bail-in and bail-outs. Part of the talk will be some research with Professor de Watripon, who is at Université Libre de Bruxelles. But I'm going to start with some general views on what banking regulation is about, and especially what liquidity regulation is about. And the first question I'm going to ask is going to surprise you. What is a bank? You know, if we are going to regulate banks, we need to know what a bank is, and it seems obvious, right? How can I ask such a stupid question? But I want to spend some time, because there are debates about exactly what characterizes a bank, because that's very crucial if you want to think about how to regulate them, right? So what is special about banks? The first is banks are very risky, we all know that. Also, we should not take that for granted. There are a lot of other economic activities which are extremely risky, and besides, we can have narrow banks which are, you know, almost riskless. So it's all endogenous somehow. Another point of view is that banks take deposits, they engage in maturity transformation, and they give rise to runs because of the maturity transformation, and the runs can be very costly. And I fully agree with this, but that's not the end of the story either, because after all, there are lots of other institutions which are non-financials, which are also engaged in maturity transformation. They take short-term debt, they can be illiquid, they can go bankrupt. Besides, if you remember, you know, Diamond and Dibwick's pioneering paper in 1983, they had this wonderful theory of bank runs. But then immediately they put the genie back into the bottle. They say, oh, but you can avoid bank runs anyway. You could use interbank lending, of course, if a bank is illiquid. You can suspend, if you have a central bank, you can suspend convertibility, you can bring some kind of liquidity assistance, lender of last resort. You can ask to have fewer deposits, so less transformation. And, you know, in the end, where is the issue? If run is a prime, well, let's take choose policies which are going to limit those primes. So in a sense, Diamond Dibwick said, you know, runs are very important, and they are, but, you know, in the end, you know, there are ways of getting rid of them. The other thing is that you don't observe them. I mean, you're going to tell me, wow, what about Lehman? Okay? But if you look over 100 years, you know, since the 1930s, in the end, you have very few runs, partly because the central banks, the treasuries, actually do what it takes to stop the runs, because they are so scared about the runs. And if you look even 2 years ago, when you had some banking crisis, you had the middle-sized banks in the US, like, for example, the Silicon Valley Bank and some others. You had Credit Suisse, of course, in Switzerland, and you had no rents. In the case of Credit Suisse, that's because you had 81 bail-ins, alternative, what's it, 81, yeah, whatever it is, you know, basically junior liabilities that you can bail in. And in the case of the American banks, they were bailouts. Okay, so they were a contribution to avoid the runs. So in the end, where are the runs? Okay, you know, we tried with Lehman in 2008, but we stopped immediately, and basically we bailed out everyone, including actually non-banks. Okay. So that's an issue. You're going to tell me banks are the foundations of the financial system and the payment system. And that's correct. That's correct. But how does it work? And in particular, notice that it works very much because there is a lender of last resort in the background, which is, you know, the central bank, possibly the treasury. So if if we are in dire straits, there will be some kind of public support. So I would argue there is more to banks than just this. I mean, all of this is correct. It's not an issue, but it's not enough as a theory. And my view is that banks are actually serving a lot of fragile and politically sensitive players. So here I have in mind retail insured and uninsured deposits. You have, and that's uninsured deposits by rich people. Think about the Silicon Valley Bank, for example. You have small and medium enterprises, and then you have interbank lendings or lendings within cross-exposure within the financial system. Okay? And in all cases, not for the same reason, there is a very strong tendency for authorities to bail out and stop the rents and so on and so forth. There are many instruments to do so. One is, some are targeted, so you target to a specific bank or to a specific financial institution. So it could be a treasury bailout, it could be the discount window, collateralized loans, but some are non-targeted. Actually, you know, one type of bailout, you will never call that a bailout, but you know, Keynesian theory tells you when things go wrong, then you want to lower interest rates. Okay? This is a bailout of the financial system, which is not targeted. Actually, we wrote a paper on that with Emmanuel Faré. It's not specific to a bank. You basically facilitate refinancing by the entire set of banks. Support to asset prices, counter-cyclical deposit insurance, and so on and so forth. So it turns out that we have lots of instruments to achieve this bailout. And again, you know, bailout is a bit pejorative, but you know, sometimes we do need them. I would say banks are not unique in this matter. It's not only banks which serve fragile players. So if you think about the defense industry, or if you're in France and you think about the farmers who are uninsured against crop prices, then they also get their bailouts. They get their bailouts, but you know, I would say by and large, the big player getting the bailouts is the financial sector, right? Now, also with Emmanuel Faré, we develop a theory of traditional banking, which is based on a coincidence between four things: prudential supervision, access to public liquidity, lender of last resort, supply of insured deposits, and loans to SMEs. So in that paper, we argue that this covariation actually is not a coincidence. So if you know, the fact that you have prudential supervision is going to reduce the cost for the state to give access to public liquidity or lender of last resort. And in turn, once you have access to public liquidity, then you can more easily supply insured deposits and make loans to SMEs, which have some ongoing feature. So basically, you have a quadrilogy of traditional banking. Second part of the introduction, and I'm going to oversimplify a huge amount because we could spend a few days on that. We moved from Basel I to Basel III. Of course, there was Basel II in between. I'm going to focus on what's going to be of interest for my talk. So in 1988, we had Basel I regulations, and basically it was a capital regulation with some liquidity features embodied into the capital requirement. So we had Tier 1 capital, which was equity, and then we had Tier 2, to simplify, was long-term subordinated debt. Okay? Things which are not going to run, basically liabilities which are not going to run. If you look at Basel III, and again, I oversimplify a lot, it separated the two. So it introduces liquidity requirement and capital requirements. It strengthens the capital requirements, and it broadens also bail-inability, so total loss absorbency capacity for the systematically important banks, so the TLAC. In Europe, we have the MREL, which applies to a broader set of banks. And we introduced 2 liquidity ratios. And if you want to think about things, we could have had more. And you might think about capital ratio as being a long-term liquidity ratio. That's a way of thinking about it. So we have the liquidity coverage ratio, LCR, which is with a 1-month horizon, defines level 1 and level 2 liquid assets. Level 1 are the ones which sells most easily with a lower haircut, and level 2 sell with a lower haircut but still bigger haircut than level 1, just to simplify. And that's on the liquid, on the asset side. On the liability side, you have what's called a runoff factor, and it's an estimate of how much might run during the period of interest. So for retail deposits which are insured, it might be 3%. For interbank transaction, it's 100%, but it can be between 5 and 40% for non-insured retail deposits, like SMEs or rich people. Now, let's think, we are going to think about how do we think about this? Is that a good thing? Is that a bad thing? And we'll try to give an answer. Before I do that, I want to add a little bit more on what liquidity is about. The knowledge here is not going to be used that much during the talk, but it underlies much of it in a sense. So you all know that in our Brito framework, where everything can be contracted upon, there will be no solvency and liquidity requirement. Basically what will happen is that we will write contract, we will have property rights on various cash flows, everything will be pledgeable. That will be the end of the story. So our Brito is not exactly what we need in this room, okay? But in practice, pledgeable income, the income that you can pledge to various claimants is much smaller than total surplus, total economic surplus, and that comes from various factors. It could be moral hazard, it could be adverse selection, it could be non-pledgeable pride benefits, whatever, and that applies all over the industry and the economy. So the wedge between total surplus in society and pledgeable income underlies much of the theory behind liquidity and solvency. Okay? Now, in the absence of a macro shock, in principle, there should be no shortage of liquidity. So another way to put it is that inside liquidity should be sufficient to cover the liquidity shocks. So if the various players in the economy had, for example, IID shocks, then there will be no issue with liquidity as long as liquidity is properly reallocated. Because there will be some players who will need a lot of liquidity and some people will have too much liquidity. So you need to have some kind of market or contracts which is going to reallocate the liquidity. Now, in the first paper we wrote on the topic with Bengt Holmström, we basically had the most embarrassing theorem we ever proved, which was basically if there is no macro shock, then as long as you properly reallocate liquidity across the players, then there is no shortage of liquidity, of inside liquidity. So basically, you don't need outside liquidity, and I will come back to outside liquidity. And the proof is one line. Let's assume that you have 3 dates, 0, 1, 2, say, to simplify. which is a framework, simple framework we're going to use later on. So at date 0, you know, the financial sector, the banks borrow. They have liabilities, and then at date 1, they will have some kind of liquidity shock each. Liquidity shock can be positive, so they need more cash. It can be negative, that means they have a revenue, they have a net revenue at date 1. But if there is no macro shock, on average, there will be an expected net liquidity need, and then they will have some pledgeable income at date 2. Okay? So basically, the future, date 2 is a future, and there will be some pledgeable income that they can pledge to investors. Now, if you borrow at date 0, that means that given that the investors must break even, I'm taking a 0 interest rate to simplify, then in expectation, the liquidity need must be smaller than the pledgeable income. That means that if you arrange things properly, you can always, at the level of the economy, finance your liquidity need from the future pledgeable income, which may require diluting existing claim orders, of course. Okay? But as long as you allow dilution of equity holders or debt holders, then that's all fine. There's no shortage of liquidity in the economy. So that suggests that if you want to have liquidity needs, you need either a wrong organization of the industry, you don't have a redispatching of liquidity, or you need macro shocks. Okay? So that's basically the kind of thing that we economists do. We say there are macro shocks, and there are sources of outside liquidity to cover those macro shocks. So that comes from outside somehow. And that comes from two sources. One is possibly the castles that you have built and you can resell. You know, there is some existing wealth that you can resell in order to cover the liquidity shocks. Could be land or something like that. Or it could be the state. But here we make a very strong assumption, but that's the best we have, in my view, but you probably have other views as well. Why is the state, the government, special? What is so special about the Treasury, about the central bank? Okay, I'm sure you have asked yourself the question. You know, the first thing that a Chicago school person will ask is, why do you need the government? And you have to ask this question in this framework as well. Do we need a government? Do we need a central bank, right? Now, I think we all have the answer, but, you know, still you have to understand why. And we make an assumption in the work with Bengt Holmström and Emmanuel Farry, which is that the state has a very exclusive right to collect future tax income. So it has a monopoly. In most countries, it has a monopoly on tax income. So basically, it can pledge the firms and the individuals' future taxes, and that's how it can borrow against those future taxes. It's more complicated than that. Renato kindly mentioned my work on bubbles, and many other people have worked on bubbles as well. But, you know, by and large, you can pledge the future income of firms and consumers. Okay? Given that the state has this exclusive right of pledging future income, then much of pledges we make as consumer, for example, is collateralized. So, you know, we may actually borrow and commit to reimburse for a house. But usually we have collateral, which is the house itself. So it's actually, we don't have that much income that we pledge ourselves. Most of what we pledge is pledged through the government. Okay? Now you might say, okay, that's fine for a country, but the country can borrow, can resort to international liquidity. The problem is that the countries themselves, and then there is a huge body of work on that as well, and probably a number of you have contributed to that, which says that, well, countries themselves have limited pledgeable income, okay? They have limited pledgeable income because of the same reasons. They can engage in more hazard, they can basically default. So that depends a lot across countries, and much of our work is actually trying to understand when a country has a lot of pledgeable income or little pledgeable income, and therefore can borrow or not. But the thing is that countries themselves have limited pledgeable income. In a recent paper, the late Emmanuel Fari and I basically look at global banking and a factor which is going to limit actually, which is going to make banks quite domestic on average. We started from the observation that in Europe, for example, we have a banking passport, so in principle you could, there are still obstacles to a single market, but still the surprising thing is how national the German banks, the French banks, and the other banks are. And basically we say, well, the banks want to be national champions. If you are in trouble as a bank, you want someone to come to your rescue. If you are Société Générale or Deutsche Bank, you know who is going to come to your rescue. There is this famous quip by Mervyn King, where he said, global banks are global in life, but national in death, right? You have all seen that quip. And that's quite true, and we explain in the paper why this is the case. So actually we get very poor risk sharing across countries, but we also get very little competition, banking competition, compared to what we should have, say, in Europe or more broadly. Okay, so let me move on to the research paper, and this is joined with an old courser and friend of mine, Mathias de Watrepont. And what we want to do is to develop a formal normative framework of liquidity and solvency ratios. And we want to incorporate both sides of the balance sheet. Okay? Now, we also want to assess regulatory reform. So maybe I will skip that because I want you to keep awake, because if you know the conclusion, you're not going to listen anymore. So I want to wait. So if you want to talk about liquidity, you need at least 3 periods, because you need an intermediate period over which there will be some liquidity shock. As I told you, it's better to have a macro shock, so we'll have a macro shock. We're going to take the simplest model. I like to, the idea is to start with a simple model and then, of course, think about robustness, but, you want to start with a single model. You can, because it's easier to understand. So we are going to assume there is no time discounting. That's not important. So the marginal rate of substitution of the investors and the others is basically 1. So their utilities are the sum of the consumptions in the various periods. So it cannot get simpler. And there will be 3 periods. So date 0 will be a period of investment. Date 1 is a period where there may be a liquidity shock. And date 2 is a future. But to enjoy the future, you must first withstand the liquidity shock. So we have a representative bank. And it has 2 sources of funds at date 0. The first is endowment, so it may have some retained earnings. We call that A. And then it's going to take deposits. And we'll see why there is a gain from trade from taking deposits. Then it's going to, and it can also, but there's also equity there. It's going to invest I in investment. It's going to be a constant return to scale model, and I will be positive that will be the amount of investment by the representative bank. It's also going to invest in liquid assets. And actually part of the exercise is to understand what kind of assets and how much. At date 1, there will be liquidity needs, or possibly liquidity needs. So the bank can pursue its operation or downsize. So basically, you have invested I, but if you want, you can reduce to J less than I. You can even go bankrupt and have J equals 0, whatever. So you choose to pursue the operation or scale down. But to continue, you need expenses which are rho times J. Rho will be the liquidity shock. If it is positive, that means you need cash. If it's negative, it's all fine, right? You can continue at full scale. So rho will be between rho min and rho max, will be in some interval. So rho positive is the reinvestment need, and rho will be drawn at date 1 from a distribution f of rho. So there will be a shock. We know the distribution, but we don't know the realization until date 1. And it's a macro shock for the reasons I've given. At day 2, there will be the future, and we're going to capture that in a very, very Mickey Mouse way. I mean, you can do much more sophisticated stuff if you want, but there will be continuation payoff for the bank. The bankers will get B times J. So B is a pride benefit of continuation, so the bigger the size of the bank, the happier is the banker. So it could be an incentive payment, it could be many other things, pride benefits. And then, we are going to discuss that in a minute, we are going to assume that society cares about continuation. Society cares about the economic activities, the SMEs, not having runs within the financial system, and so on and so forth. So that will be it. So beta J will be basically the value of continuation for society, for the social planner. There will be 3 sources of liquidity in this model, and each source will have possibly an haircut. So it may be the case that you get 100% of the value of the asset, but you may get 95 or you may get 90. We are going to assume that this 1 minus theta is the haircut, so theta is the fraction you get by selling the asset. We are going to assume it's a constant. It could be a function of rho as well, because you might think that when things go wrong, then it's harder to sell the asset, right? But that's fine if you want. So the first source of liquidity is market liquidity. Market liquidity means that you resell assets. So we are going to assume there are liquid assets, A. There are different liquid assets. So you might think about treasury bonds and municipal bonds and whatever. And those are things that have a very low yield. Actually, remember that the marginal rate of substitution is 1 from one period to the next. So we are going to assume that if you buy those assets which are liquid assets, you buy them only for their liquidity. For their yield, it's not worth it. So, for example, if it's L to maturity, which means L to day 2, then you'll get a return RA which is less than 1. So it's a money-losing proposition if there were no liquidity need. If rho were negative, you'll never buy those assets. Besides, you may have an haircut. So if you sell at date 1, so it's just like in Diamond Dibwig if you want. If you sell at date 1, you're going to get theta A times RA. Theta A, 1 month A haircut times RA, which is the return if L to maturity. And to make this interesting, we want to have no dominance between the assets, because otherwise you will be holding only one liquid assets, right? So we are going to assume that some have a very low return but are extremely liquid, so theta A might be 1 or close to 1, and some have higher return but they are less liquid, so they have a bigger haircut. Second source of liquidity, funding liquidity. So funding liquidity is on the liability side. So the first thing you can do, so those of you who know my work with Bank and Emmanuel know the notation already, but basically there's some pledgeable income which is proportional to the scale of continuation. You can micro-fund that. You can give micro-foundations. So basically, you can resell those assets, and then you get rho 0 times J. We are going to assume it's not self-financing. So if the shock is very big, just reselling the asset is not going to suffice. And think of that as being equity, or very risky debt. But then, and I'm going to come to that, it's going to be very important, then there are deposits. So this is the trick. I told you that everybody is risk neutral, and I'm going to keep this assumption, but yet create some kind of risk aversion. Okay? So I'm going to assume that banks can basically acquire deposits at debt zero, and those are deposits in limited quantity of people who want to have some amount of money at date one, for sure. So they want to send their kid to college, they want to buy a house, they want to insure against the loss of a job, blah, blah, blah. And it could be an SME who really need the money tomorrow. That's very important. So we are going to assume there is a limited amount of such deposits. They will be called cheap deposits. And the reason for that is that to get one at date one, $1 at date one, they are willing to pay 1 over theta d at date zero, where theta d is less than 1. Okay? So they are willing to pay a premium to make sure that they get the money at date one, because they're still risk neutral in a sense, but if they don't get that dollar, they actually suffer a loss. Okay? Because there is some good opportunity they are going to miss. Okay? The rest is ordinary depositors with marginal rate of substitution equal to 1. And finally, public liquidity. So we wanted to avoid a general EQM model, which is very complicated. So we are going to take a very simple form, very tractable. I mean, you could make it more appealing and broader, but we are going to assume that the government, and here I'm not taking side if it's a central bank or the treasury, is going to the interpretation of the lambda will be different. But the government transfer to the bank will be called G for the government, GT, which is positive or negative. But the important thing is at date one, there will be a cost if there's a transfer to the bank. So we are going to assume that if the transfer G1 is positive, so you give money to the bank, then there's a cost, like a deadweight loss cost, lambda, and there are multiple interpretations. One is maybe a political backlash cost. If you give money to the bank, then it's a backlash in the population, or it could be that, the public finances are no good, especially when there's a bad shock, which is when this is going to happen. And then, the shadow cost of public funds goes up. There may be even difficulties with refinancing on the international markets, and so on. Now, we are going to make, so lambda will be a cost of basically liquidity assistance. The parameter beta I told you about, which is the valuation for continuation, the social valuation for continuation per unit of reinvestment, is going to satisfy a simple assumption, which is not needed, but it shortens the analysis, which is that the government always wants to bail out if needed. So basically, imagine that you have the highest possible shock, rho max. Now, you can always dilute equity and get theta 0 times rho 0 per unit of investment. So the net shock to be met is rho max minus theta 0, rho 0. You may think of this theta 0 as being 1. And then you have to pay 1 plus lambda if you want to finance this. But you are willing to do this because you really care about the continuation. And given the history of the last 90 years, this is a right assumption. Okay? This is a right assumption. Now, as I said, parameter beta may capture the protection of depositor of SMEs, the avoidance of fire sales, and so on. Now, I'm not saying that the government cares about bankers. Actually, in the model, the government puts zero weight on bankers, but it it puts weight on the continuation in the economy. Okay? Okay, so summing up, at date 0, you have the balance sheet determination, there is an investment, then there's a liquidity choice, which is going to give rise to liquidity regulation. So you hold various liquid assets, LA, you take deposit, LD, and you could have long-term security insurance like equity. Then you have, at date 1, the realization of the cash need. You can sell liquid assets if you need to. You can bail in depositors if you need to. You can dilute equity if you want. And then you continue at scale J less than I, which will always be I, because the government cares about continuation. So in equilibrium, J will always be equal to I. And then the realization of a future which is uninteresting, because that's the pledgeable income is paid to investors, the insiders get benefit BJ, which will be BI, and then there will be social benefits. Renato, you tell me how well. I don't have a watch, so 20 minutes, okay. I don't want to fall liquid, but you'll be bailing me out, or the coffee break will be bailing me out. I'm sure I will be very popular with this, but okay. So imagine you have no supervisor, banking supervisor. That will be a disaster. What will the banks do? Well, it's obvious. Liquid assets have a very low yield. Then the government is eager to rescue you if there's a shock and you cannot continue, or at least you cannot continue full scale. What do? No liquidity, zero liquidity. LA equals 0 for all assets A, okay? You can even go further, because if you have deposits which are highly sensitive, so theta D is very low. Remember that depositors are willing to pay 1 over theta D to get 1 at date 1. So if theta D is low, that means that they care a lot about getting the money back. And those also will be bailed out. So the banks will actually take cheap deposits, because they know, and the depositors as well, know that even if they are not insured, they will be covered by the state. Okay? So this is not going to be a good situation. We are not the first to notice that. There are a number of papers basically noticing that there will be interventions for various reasons. So what we are going to do is to look at the optimal contract. I'm not going to derive it, I'm just going to give you the properties. So what is the optimal regulatory contract? Well, for that we need to define a reservation utility for the bank. There are various possibilities for that, the bargaining power, whether it can be a shadow bank, blah, blah, blah. So we're going just to take a simple view of that, totally uninteresting. By the way, this is going to define the solvency ratio in this, the maximum amount of investment you can do. But honestly, there is nothing interesting in this model. The entire interest will be on liquidity. So there will be a reservation utility, wherever it comes from, for the bank, U lower bar. If B, we're going to assume that B is large enough. So basically, if the bankers get high pride benefit from continuation, then it wants to be paid in continuation, not in cash. Okay? So basically, it's going to get B times I, because the scale of continuation will be I. So B times I must be greater than U lower bar, and that's going to determine I. As I told you, nothing interesting there. But we still need, and that's something we have been doing repeatedly with Emmanuel Faré, that beta is going to be large, but not so large that the authority would like to subsidize and get a very large investment. I mean, here with constant return to scale, if beta were very, very large, then you'll subsidize and you get some kind of infinite investment. Okay? We don't want that. So you have also to put an upper bound on beta so that you limit the scale of the bank. Okay? Which is realistic as well. Okay? The authorities are willing to bail out the banks, but they are not willing to subsidize at day zero the bank. Okay? So let me tell you about the optimal regulation. The first result is important, but it's not new. Actually, we had it with bank, for example. In the optimal contract, regulatory contract, you want public liquidity assistance only in tail events, only in big macro shocks. I mean, it's not going to surprise you very much, but at least it's reassuring to know that you will get, in the optimal contract, you'll get basically involvement of public funds only if you have big macro shocks. So if rho is greater than rho star, where rho star is less than rho max. Why is that? Actually, it's always optimal to have some liquidity assistance. Why? Because in tail events are very unlikely. So are you going to buy, for example, very costly assets to get insurance with probability 0.1%? It's inefficient. Then you want the state to step in and actually bring this liquidity assistance, right? So you're not going to buy insurance which is extremely costly for events which have very low probability. And that's a much more general result. For lower shocks, so rho less than rho star, you have a pecking order on the asset side and on the liability side. So on the asset side, you are going to do exactly what's being done now. So you are going to dispose of low haircut assets, or high theta assets first. I mean, of course, if rho is negative, you don't have to dispose of assets. You don't need to incur haircuts because you have enough money. But if rho is positive, you have to dispose of assets, maybe. You are going to start with the low haircuts assets first, and then you are going to move on to assets which have a higher yield but a higher haircut. Okay? It's exactly the same thing for those of you who have done I/O and have learned Brito's famous work on optimal plant management for electricity grids. It's exactly, you use off-peak stuff which is pretty cheap, and then you use peak stuff which is expensive. And you do exactly the same thing. It's just like electricity markets here. Then on the liability side, you are going to bail in. You are going to bail in some of the deposits. And then there will be two categories of deposits. The ones with a high theta D, so they want to get money at date one, but it's not that important. Then, so if 1 plus lambda theta D is greater than 1, they will be bailed in before public funds are spent. And there will be a pecking order. So you will start with the theta D close to 1, and then you move down the theta D order. Then, when theta D is very low, so that means people care a lot about getting the money at date one, then they will be insured, which means they will never be bailed in. Okay, so you have those two categories. And again, for those of you who have read Bob Wilson's book on priority servicing in electricity markets, it's just the same. You get this pecking order, it's very similar. I'm not going to get into that, don't worry, but interesting result that I will be discussing later on is that the optimum can be decentralized through a liquidity rate. I mean, the risk-weighted asset ratio is going to be a LWA ratio in a sense, where you weigh the various assets through the haircut. Okay? By the way, it's something that is done in Basel III. So you get exactly what's being done in I'll criticize Basel III later on, but you get exactly what's being done in Basel III. Okay? So if you look at this, I don't know if it's going to work. Well, whatever. So if you look at this, first you have the you can dispose of the assets, liquid assets with the haircut, the theta A here, or the haircut is 1 minus theta A. You can dilute equity, and you have to cover both the shock when you start spending funds, which is rho star times I, and then you have to pay the deposits which are not bail-inable. So those will belong to the category B delta 2, which are basically the insured deposit, because they have to be paid. So you need cash for that. And basically, that's all you have to say. You need this amount of liquidity, which covers your deposits plus rho stars times I, okay? And then you delegate the choice of liquidity instruments to the bank. You don't have to actually go into the nitty-gritty detail of liquidity regulation. Why is that? Very simple. The reason for that is that there is one externality. The externality in this model is an externality on public finances. So that's why you need enough liquidity to cover all shocks up to rho star, but the way you cover them, you just don't care. Because what matters is the externality, and you want to have enough liquidity. You regulate the level, you don't regulate the structure. Okay? Okay. Now, what this means, and that's going to be important, is, and that's why I'm going to start criticizing Basel III, which is a pretty clever regulation nonetheless, but when you are serving large households, rich households, for example, which are not insured, or the part of their savings which are not insured by deposit insurance, or SMEs, then the theory tells you, the previous slide tells you, they should be either paying deposit insurance or being covered by liquid assets. And here is one big flaw of our regulations today, which is you have players who can very easily run. One click can run. First rumor, you can basically leave and basically not be bailed in. Even so, you are not covered by any insurance. So basically, you get your cake and eat it too. On the one hand, you basically can run and never incur any loss. And on the other hand, your bank doesn't pay for deposit insurance or doesn't have to hold liquid assets which are costly. And there's something very bizarre, because if you are a retail depositor and insured, then your bank has to pay deposit insurance, right? Those have exactly the same claim. It's perfectly insured de facto, not de jure, but they are de facto insured, and they are not paying for that. And by the way, even if they are too slow and they didn't run, then they still will be bailed out. So there is some asymmetry which is very bad. If you are a depositor and you can run and so on, or you are insured by the government, for whatever reason, you should be paying for it. And that's no surprise that today you have so many depositors who are side depositors and not covered by deposit insurance or not covered by liquid assets. The big exception under Basel III is interbank loans. Because interbank exposures, there you have a runoff factor which is 100%. And that's the right thing to do. But they do it only for interbank or financial sector creditors, and they don't do it for rich individuals, they don't do it for SMEs. And that's just wrong. Okay? The second thing is that this coverage doesn't mean that you should have a narrow bank, because if you look at this even in this simple model, if you rewrite things, then you can rewrite it this way. So, in blue there on the left, you have basically the deposits and then you have the liquid assets. So in a narrow bank, the liquid assets will cover the deposits, right? But if you look at the equation, then basically you may get liquidity sources from public funds, that's for rho greater than rho star. You have to pay shocks, so because a bank is risky, rho I. Then you will have the dilution of liability side claims, and then you have the unused liquid assets when the shocks are not too big, because you still have the liquid assets at that point of time. So you see that what matters is the liquidity equation, but liquidity can be brought by various things. And that's consistent with a very risky balance sheet with maturity transformation and so on. So I'm not talking at all about a narrow bank. But I'm saying, look, you need to, any player who has de facto a deposit and can run should actually be paying either for deposit insurance or for liquid assets, and because it's not been enabled by definition. So let me quickly finish, and before Renato takes the stage and says, no more. Extension, some very important extension. The first is what happens when you have shallow markets. So there is a huge literature, which is very important, on fire sales. The fact that when you sell your assets, then you are going to lower the price because the market is shallow. And that's going to have an impact on other banks because they may want to resell, and they will in this model, to resell this asset in bad times. So we formalize that, and then we find that just regulating the level is not enough, the level of liquidity. You also want to regulate the structure of liquidity. Why? Because now you have two externalities, and because you have two externalities, you need two instruments. There is an externality on public finances, but there is an externality on other banks, because when they resell their asset, if you resell your own assets, then you reduce the price they are going to get. So what we show, for example, imagine that you have two liquid assets. You have level 1 assets, which are perfectly liquid, but you have level 2 assets where you can have fire sales phenomena where the price goes down when you have more resale. So theta 2, in a sense, is decreasing with sales. And then you need more than an LWA ratio. You need to have two instruments. And that, by the way, that's exactly what Basel III does. Okay? And the justification for that will be this second externality through fire sales. Another important extension is if you don't have an international market, and I told you that countries have limited pledgeable income, they cannot borrow as much as they want, and there is not perfect liquidity regulation at the world level for good reasons. But that raises the issue about what are these liquid assets. So in practice, they are often treasury bonds or municipal bonds and whatnot. And as particular level 1 liquidity, often are covered by sovereign bonds and similar securities. But if you have segmented international markets, you ask yourself, can you have the same regulation for a country like Australia or Denmark or whatever, which may have public debt of 20% or 30% or 40%, and Japan, which has public debt of 200% or 220%, whatever. So the supply, what we did was just to look at the demand for liquidity. But then there is a supply of liquidity, which is not the same in different countries. If there was only one financial markets in the world, that would not matter. But if you have different financial markets, but at the same time, Basel III regulations are the same for everyone, then there is an issue. So we study the case where you have more or less liquid assets, and we show that you should adapt if, your regulation, if you have a low level, there typo, with a low level of level 1 asset. No, that's fine. Because it's going to affect the return on safe assets. And in that case, you need to have more use of level 2 assets. Okay, because you have very few level 1 assets. You need a more use of level 2 assets. And by the way, this is exactly, for those of you who know a little bit, level 2B, 2A and 2B, you also have that in Basel III. So let me conclude. The LCR, for example, fits well with the theory on the asset side. HQLA's high-quality liquid assets are weighted by their liquidity discounts. That's the right thing to do. There is a minimum percentage of higher quality assets. That was the remark I just made. If you don't have enough level 1 assets, you want to substitute by level 2 assets. Something I didn't discuss is whether you should have a 100% runoff factor within the financial sector. In the paper, we say it's probably the good thing to do, but I won't have time to discuss that. Basel III is weaker on the liability side because while interbank exposures or cross-financial exposures are well treated, SMEs and rich uninsured depositors are not, they are being subsidized. And they are having their cake and eat it too, and we object to that because they have de facto insurance. They don't have de jure insurance, but they have de facto insurance. And there is a lot of future work that you are going to perform, I hope. And let me thank you for your attention. It's a great pleasure to be here.
So I guess we have the time for a few questions. Vinicius, she's coming with the microphone.
Fascinating, Professor. Thank you so much.
Thank you. Yeah. I hear you, but I'm not sure they will be heard in the back.
That works. Fascinating, Professor. I have two questions, actually. So the first one is whether, the fact that you can delegate the liquidity requirement means that you don't need commitment by the regulator. Because from my understanding, you have to somehow guarantee and enforce the dilution of equity. How can you do that without commitment if you play a chicken game with the bank exposed in an exposed stage? I guess the second question is more of an applied take. So I suppose that, for instance, in the Silicon Valley crisis, those CFOs in tech companies should not be insured, and they were de facto. So again, the question of commitment, whether you can allow some, depositors not being de facto insured. Thank you so much.
No,
a real honor.
It's very interesting, and you're right. I mean, but that will be true of any theory of regulation somehow. You need to have strong commitment by the authorities, because otherwise, the banks will realize that and may take advantage of that. So you want to make sure, by the way, for those assets, they have to be unencumbered. So of course, they should not be pledged to somebody else, because then, of course, it's not a source of liquidity. And, same thing, you want to be able to dilute equity and all those things. So we cannot avoid that. So the theory basically assumes that there's a commitment to that. And, you might question sometimes. I mean, there is one thing where you don't have commitment, which is mutually advantageous renegotiation. So, with the beta. So even if the central bank or the treasury is not committed to bail out the bank, it cannot refrain from doing that. But it's a form of non-commitment, which is that you can always be nicer. But you also want to be able to be tough. So to say, no, we are going to use those assets. You said they will be bail-inable. and you have to build them in before. It's a TLAC kind of stuff. You can always say, well, maybe not. The central banker may be captured, or maybe some, the equity owners might, have some story, might be fragile themselves. But in the end, you have to make sure when you regulate at the zero, in a sense, you have to make sure that there won't be any problem of abiding by the commitment.
Thanks.
Thank you, Professor, for a wonderful presentation. Okay. I'm from the BIS, but I won't be defending Basel III. I just have some naive questions. Maybe I'm not an expert on the topic, but the first one is like society complains about how we socialize the losses, but we privatize the benefits. So I mean, beyond having this liquidity and those indicators trying to protect them from tail events, how can we be more symmetric from bad tail events and good tail events whenever bankers get extraordinary profits? So is there a framework for that or not? And my second question will be, how would you characterize the shock we are dealing today? Is macro, is uncertainty, is the perception of risk has changed? And how do you think the banking sector should be prepared for this current situation?
For the current situation, okay. Well, thank you. Those are good questions. In a sense, what we are doing is trying to avoid, this basically socializing the losses and basically having profits prioritized. And that's what prudential regulation is about. So we want to avoid those things, which raises the issue of commitment, of course. So we need that. Banks are very clever, of course, and if there are loopholes, then those loopholes will tend to be exploited. But that's true in any kind of regulation. I've been studying over the years many forms of regulation, not only financial. And of course, anytime you have a loophole, which is unavoidable. I mean, by the way, as I mentioned, Basel III has a number of very clever rules. I mean, I criticize Basel III, but it also has some very clever rules. But we'll always get it wrong. We know that. What we can do is limit the damage and make sure that we anticipate things. So it's clear that if you think about Lehman and so on, there are always banks which have very few scruples and are going to exploit the situation. So, basically, in the case of Lehman, correlate all exposures, right? They do things which are going to basically increase their put on taxpayer money. So some people will say, oh, but banks don't like to go bankrupt because, of course, they lose money, their reputation is damaged. That's correct. But the point is that they will never internalize enough the loss on society. Because, the downside in the end will be paid by the taxpayer or, inflation or whatever mechanism you use. So we need to realize that, and we have, just like in any regulation, we want smart regulation. We don't want regulation which is going to prevent economic activity from happening. So we have to be industry friendly, but at the same time we have to realize that the industry will take advantage of whatever mistake we do. And we always make mistakes, but at least we can limit those mistakes. And that's what this kind of research that we're all doing is trying to do. And basically try to say, no, you cannot have your cake and eat it too, and we are going to constrain you. Now, your other question was about the current situation. And can you be a bit more specific about it? I'm not sure I will be able to answer, but...
No, just wondering, this change in perception of risk, relative risk versus the U.S. versus other countries, bond market, How do you think this high uncertainty will affect the banking sector, and if we could change something to prevent a crisis?
I think it's very difficult because as you mentioned, we are in new circumstances. We hadn't anticipated quite. By the way, just let me criticize a little bit the research we do. Here we have this distribution of a shocks F of rho, okay? And we derive a rho star from that. But, what is a rho star we want? And, now if we can quantify, that's not very difficult to do. But, again, this distribution is very unknown in practice. And we are in a situation right now where it's more complicated. It's more complicated. Are we going to get a recession because of the tariffs, for example? Are we going to get, it seems, it changes every week. Are we going to get a very weak dollar? Donald Trump would like a very weak dollar. And there are many ways of doing it. He's trying to get other countries to sell their treasury, US Treasury bonds, but there are other ways. He's going to create some inflation domestically. Some people have even thought he might repudiate things. You never repudiate, of course. You restructure. You restructure, and you could have a restructuring of, that would be unheard of. Can you imagine the world reserve currency going through what de facto is a default? That would be a huge mess. So what will replace? It will be the euro, possibly. The euro, so far, hasn't succeeded for many reasons. Hasn't succeeded in replacing the dollar, and there are reasons for that. Part of this is public finance. The U.S. has, of course, a lot of pledgeable income in some way. And despite doing something I don't like, has a benefit from having low taxes, which means that if something goes wrong, I think those low taxes are very unfair and very unequal, but it has one benefit, which is that you can always raise the taxes if push comes to shove, right? You can always raise taxes. You have protection of investor income in the U.S., partly because the American people savings are invested in the stock market, and so you can go on and on, which implies that actually the U.S. is a reserve currency, and still, people have said, it's going to be replaced at some point by the RMB, by the euro and so on, but it has happened. But it might happen with Trump. You never know, if he goes on with his policy. But there is a huge amount of uncertainty. So for me, making a prediction is a bit dangerous because I'm going to get it wrong, and I'm a bit risk averse, to be honest. But it changes every week, so you know probably much better than I do, honestly.
Okay, so we have the time perhaps for one last question. Okay, so I can have a go. You're mentioning, in a sense, the theory of regulation that you propose, it insists on command and control measures, right? So it's liquidity-weighted requirements on assets and so on. I wonder if you could deliver similar things using price signals or price incentives, for instance, on the design of deposit insurance.
That's a good question, and with those kind of regulation, you can, and that's what Renato is alluding to, you can either use price signals or quantity signals. It's true for, you can have a carbon tax, or you can have a quota, emission quota, for example. There are many things like that, and the question is, what is the best? So we go back to Weitzman's early work in the 70s about what is the best instruments. And in a sense, we use both, because once you use treasury bonds, for example, as a liquid asset, then you also issue a number of treasury bonds. At the same time, you also put that price, so the prices come from the market as opposed to, and that's the case for most assets, right? The prices. So, but the answer, I mean, this doesn't arise in this paper because we know the aggregate structure of the economy in this paper. There's a randomness about the shock rho, but that's about it. There is no other uncertainty. But if you have more uncertainty, because, for example, you don't know the structure of banking, for example. Some banks will have big shocks, some banks have lower shocks. Then you have multinational things. So, some of your assets will be purchased abroad and so on. Then obviously you want a finer instruments, and you'll have uncertainty about which one is the best instrument. Not in this model. I cannot answer this question in this model. It's too simplistic. Mm-hmm. But you are right. It's very interesting to apply the kind of Weitzman approach to understand which way to do it. Probably some of you are actually much more expert in the field than I am, but as you might imagine, and that will be the conclusion of this paper, is that there are many things to do to get the right picture somehow of what should be done, but it's just a small start.
So I think it's time now for the coffee break, so thank you so much.
Thank you.
Nossos agradecimentos ao diretor Renato Gomes, diretor de organização do sistema financeiro e de
Financial System and Resolution here at the Central Bank of Brazil, and Professor Jean Tirole. We remind you that after the break, the academic sessions in macroeconomy will take place in this auditorium Bulhões, and the microeconomy sessions will take place in the auditorium across the whole Auditorium Nogueira. The opening session and opening speeches today were broadcast live through the Central Bank channel on YouTube and will become available for public access. The academic sessions that will follow will be recorded and made available later on our website. We will now take a 30-minute break. We invite everyone to have some coffee in the hall.